Listen, everyone keeps telling me they're waiting for that perfect pullback in silver, that beautiful clean dip where everything lines up and you can just back up the truck and load up. And I'm going to be completely honest with you. I think that moment you're waiting for might never actually come. Or if it does come, it's not going to work the way you think it will. And here's why. Because there's this massive assumption baked into that strategy that nobody's really questioning. The assumption is that when paper prices dip, you'll magically be able to walk into any dealer or go online and buy physical silver at normal premiums, in normal quantities, with normal delivery times. And I'm telling you right now, that assumption is becoming more dangerous by the day, because the paper market and the physical market are not the same thing. They're cousins maybe, but they don't always move together, especially when supply gets tight. So let me paint you a picture of what's actually happening right now. Silver just had these massive intraday swings. I'm talking about drops that would have made headlines a few years ago. And you know what happened after those drops? The price bounced right back up. It recovered near record highs. And that's not weakness, that's repositioning. That's smart money shaking out weak hands and then scooping up what they dropped. And if you look at the raw dollar moves in both gold and silver recently, they've been absolutely wild. Sure, the percentage might look smaller because the absolute price is higher now, but in actual dollar terms, these are extreme moves, and the fact that prices are holding near these levels after those violent shakes tells me something very clear. There's underlying strength here, not exhaustion, and that's the first clue most people are missing. Now here's something that keeps me up at night, and it should probably keep you up too. Gap risk, because metals don't just trade during your convenient 9 to 5 Eastern Time hours. They trade 24/7 around the globe. London's open when you're asleep. Asia's trading when you're having breakfast. And all it takes is one holiday weekend, one period of thin liquidity, one major exchange being closed, and boom, you wake up Monday morning and silver's up 15%, and you're sitting there with your coffee thinking, I was going to buy on the dip, except the dip already happened and closed while you were scrolling through your phone on Saturday night. And that's the danger of waiting. You're exposed to time zones and events you can't control, and gap risk doesn't care about your plan or your perfect entry price. But let's talk about something even more important, the difference between paper and physical, because I see so many people treating these like they're interchangeable, and they're absolutely not. The paper market is where contracts trade, where ETFs move, where billions of dollars can flow in and out with a mouse click. It's fast, it's liquid, it's efficient. But the physical market, that's a completely different animal. Physical metal has to be sourced from mines or recycled material. It has to be refined, minted into coins or bars, shipped across countries, cleared through customs, and then delivered to your door or your vault. And every single one of those steps takes time, costs money, and has potential failure points. So when supply tightens, here's what happens. Paper prices might actually drop because traders are selling contracts, but physical premiums can skyrocket because dealers can't find metal. And suddenly that 5% dip in spot price means nothing because premiums jumped 8%. So you're actually paying more in real terms. And that's the trap everyone's walking into. I know some of you are thinking, well, I'll just buy an ETF and avoid the premiums. And look, I get it. Paper exposure works great for trading. It's liquid, you can get in and out fast, spreads are tight, but here's what you're giving up. You're giving up ownership. You're taking on counterparty risk. You're trusting that when things get really bad, that ETF will actually deliver, or that you'll be able to sell it at a fair price. And maybe that's fine for a portion of your portfolio. Maybe that's fine if you're trading. But if you're buying silver because you think the system might have problems, then holding paper exposure to silver is kind of like buying fire insurance from a company that might go under in a fire. It defeats the purpose. Physical metal eliminates counterparty risk. It's in your hand, in your safe, under your control. And during systemic stress, that difference matters more than any premium you paid. Now let's address the elephant in the room, the financial media and their predictable cycle. Every single time metals rally, it's called speculative, it's called a bubble, it's called irrational. And every single time there's a dip, they say, see, we told you, it's over, go back to stocks. And this cycle is designed, whether intentionally or not, to paralyze you, to keep you second guessing, to make you wait for certainty that never comes. And I'm telling you, stop listening to narratives and start watching mechanics. Watch premiums, watch availability, watch delivery times, watch what dealers are actually actually saying when you call them, because those signals don't lie. Headlines lie. Talking heads have agendas, but a dealer who can't get product or a mint that's rationing sales, that's telling you the truth, whether they mean to or not. Here's something most people completely overlook: mining stocks. And I know, stocks feel risky right now, but hear me out. Miners are leveraged plays on metal prices because they have fixed costs. When silver is at $18 and it costs them $15 to produce, they're making $3 an ounce. But when silver hits $35 and it still costs them $15 to produce, now they're making $20 an ounce. Their profit didn't double, it went up 600%. And this effect is non-linear, it's explosive, but Wall Street is terrible at pricing this in quickly because analysts anchor to old prices. They assume mean reversion. They build models based on historical norms that might not apply anymore. So you get these lag periods where the fundamentals have completely changed, but the stock prices haven't caught up yet, and that's your window. And here's a bonus most people miss. Many gold miners produce silver as a byproduct, so when silver prices rise, it doesn't just add revenue, it actually reduces their effective cost of producing gold. And that margin expansion often gets ignored in analyst reports. They focus on the primary metal and treat byproducts as footnotes, but those footnotes can completely change the profitability equation. And when the market finally figures this out, the repricing can be violent and fast. I'm talking about stocks moving 20, 30, 40% in days, not months, because belief catches up to reality all at once, not gradually. Let's zoom out to the macro picture for a second, because this is where it all connects. Metals are forward-looking. They don't react to last month's inflation report. They react to shifts in confidence, confidence in policy, confidence in leadership, confidence in central banks, confidence in fiscal discipline. And right now, if everything were truly stable, if everything were truly under control, gold and silver wouldn't be behaving like this. They wouldn't be near record highs. They wouldn't be absorbing massive intraday sell-offs and bouncing back. The market is telling you something, and that something is concerned. Concern for long-term purchasing power, concern for systemic credibility, concern for what happens when the debt keeps growing and the deficits never close, and the only solution is printing more currency. And precious metals are the opt-out. They're the exit door from that dilution. Now, I want to talk about something that affects you personally, affordability, because you feel it every time you buy groceries, every time you fill up your tank, every time you pay rent or look at your mortgage statement. And people say, oh, prices are going up. But that's only half the story. The other half is your currency is buying less, globally, in real terms. And even if your wages go up 5%, if costs go up 8%, you're getting poorer, you're working harder and falling behind. And that's not a bug. That's a feature of monetary policy that prioritizes short-term stability over long-term value. And the people who understand this are the ones standing in line at coin shops, the ones stacking physical metal, the ones who realize that holding cash is like holding ice. It melts a little bit every single day. Here's something that doesn't get enough attention: trade data, because everyone celebrates when the trade deficit improves, but nobody asks why it improved. If it improved because you're importing less because your currency buys less, or because you're literally exporting hard assets like gold to pay for things, that's not strength, that's weakness disguised as good news. Selling your assets to make the numbers look better is not economic growth, it's liquidation. And when one country reduces demand, other countries step in. So the real consequence is your standard of living drops while someone else's rises. And metal flows follow that pattern. Gold and silver move from weak hands to strong hands, from weak currencies to strong currencies. And right now, I'm watching those flows very carefully because they're telling a story the headlines aren't. Now let me tell you what I think the next crisis looks like. And I don't think it's going to be a consumer crisis or even a banking crisis. I think it's going to be a sovereign debt crisis. I think the stress point is going to be government balance sheets, not household balance sheets. And when that happens, when the quote-unquote safe assets, like government bonds, start getting questioned, money moves fast. It moves into assets with no counterparty risk. It moves into things that can't be printed or diluted or defaulted on. And that's gold, that's silver, that's physical metal that you can hold. And if I'm right, the repricing won't be gradual, it'll be sudden, it'll gap up overnight, and everyone who was waiting for the perfect dip will be left behind wondering what happened. Let's talk about inflation for a second, because the official numbers keep telling us things are fine. Inflation's cooling, everything's under control, but then you talk to real people and they're saying their grocery bill is up 30%, their insurance doubled, their rent went up again, and the quality of products is worse. They're getting less for more. And that's the substitution effect. That's shrinkflation. That's all the things that don't show up cleanly in year-over-year statistics. And even if the headline number says 2%, your lived experience says 10%. And metals respond to lived experience, not to government reports, because people buy gold and silver when they stop trusting the official story, when the gap between what they're told and what they see becomes too wide to ignore. And here's the thing about silver specifically. Silver is the amplifier. Gold signals concern, but silver signals urgency. When silver starts outperforming gold and refusing to give back gains, that's when you know